The Federal Reserve announced its third quarter point interest rate cut of the year today. That brings floating interest rates to between 3.5% to 3.75%. You'll feel those effects from your savings account to your credit card payments. Fox 4's Jacob Sloan joins us live at Kansas City's Federal Reserve. He spoke with a local economist about the cuts and why you could see more in the new year.
Scott, that decision is meant to balance inflation with our job market. And Fed Chair Jerome Powell said today that while inflation is higher than they'd like it to be, the decision was largely fueled by our current job opportunities.
The job market is slowing, and that has the Fed in balancing act mode.
With downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate.
While the Fed aims to balance inflation and the impact of tariff policies with the job market, Chair Jerome Powell sees the softening of the labor market as one of the reasons for the cut.
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well.
Regionally, experts say our economy is strong. The Kansas City and Chicago Fed governors voted to keep the rate unchanged, suggesting they view the Midwest economy stronger than the coasts.
So we are in a better corridor, and so I think that this is reflective of Governor Goolsbee in Chicago and Governor Schmidt in Kansas City, reflective of their districts, which say, really things are okay here, but it's the rest of the country where they're seeing, a little more weakness that they're willing to cut rates.
It's the third cut this year, but Colbert says the real impact won't be felt for another year or more.
So they've been bringing rates gradually down over the last year and a half, if you will, or year and a couple months. And gradually, this should help spur the cyclical part of the economy, which had been kind of in the doldrums.
That's things like cars and appliances. But Colbert says not to expect a drop in mortgages. As more job data comes in, Colbert expects more rate cuts in the new year.
I think basically on the job side of things, you're going to see fairly weak statistics, which could push the Fed eventually next year, I believe, to cut once or twice as the year progresses.
Future rate cut decisions could also be impacted by a lack of job data, as they're still looking to regain numbers from the government shutdown in October and November. The next Fed rate cut decision, Scott, is expected in late January.